In this video, I'm going to talk about some of the high-yield dividend investments that I've been buying over the past couple weeks. In the case of all these purchases, I really have two main motivations for buying them. Either I believe they're currently discounted and present a good buying opportunity, or I'm looking to build up certain positions in my portfolio that I believe I'm underexposed to. As is the case in all of these videos, be sure to do your own research and come to your own conclusion before considering any investment for yourself. There are a mixture of high income and dividend growth holdings that I'm going to talk about today, so some of them come with different strategies, and in my opinion, some come with a lot more risk than others. The first high-yielding stock that I've been buying even more of in the past couple weeks is Capital Southwest, ticker CSWC. They're a business development company that provides flexible capital solutions to help lower middle market businesses grow through acquisitions and capital investment. According to their website, it says they focus on thoughtful and timely responsiveness that balances preservation of capital and long-term shareholder returns. Capital Southwest is the oldest BDC in the sector, having functioned as a BDC since 1988. Following a strategy change in 2015, this company has consistently been one of the best performers in their entire sector. But despite their really good track record, Capital Southwest is a stock that the market began shunning in October of last year. The share price of CSWC fell by almost 19% in the months following their second quarter results, which reported some concerning numbers. Their non-accrual percentage, which is the percentage of companies that they've lent money to that have been unable to pay them interest on their debt, had unexpectedly jumped to 3.5%, which is higher than the BDC sector average. This played a role in their regular quarterly dividend being less covered compared to their long-term norm. Despite these concerning results, I took the opportunity to buy more shares of this company over the past few months because I felt like the sell-off was overblown and I had confidence in the management team. Because despite what this company's been reporting, they've still been paying special dividends every quarter. They've done this pretty consistently, as you can see here, which led me to believe that things might not be as bad as some people have feared. Thanks to the sell-off, the dividend yield eventually soared to over 11%, which is still in that neighborhood today. But last week, this company released their most recent financial results, which were full of good news. They saw a big improvement in their non-accruals, and they currently sit at 2.7% of their investments. This would now make them slightly better than average compared to the BDC sector. They also reported a significant jump in the number of new investments they've made. Capital Southwest pledged over $313 million in new committed credit investments during the quarter, which is really significant in just one quarter. What's even better is roughly half of their new commitments are with companies they've previously done business with, so they aren't strangers and they've obviously had success with them in the past since they're getting even more funding from this company. CSWC's NAV has also been stable, which is good to see. So overall, given their most recent financial results, I still feel good about the dividend safety of this company as they're moving in the right direction. The next holding that I've been buying recently is QQQI, the NEOS Nasdaq 100 High Income ETF. As you can probably guess, QQQI follows the exact same strategy as SPY, only on the Nasdaq 100 index. You can see that this ETF offers a really attractive dividend yield, currently over 14%, and it pays monthly. I regularly get questions as to why this isn't my favorite income ETF and why I prefer SPY, since QQQI offers the better dividend yield. And the reason is, the Nasdaq 100 is a much more volatile index and can have much more dramatic share price drops. It's likely unthinkable to newer, younger investors, but when the dot-com bubble burst, which was when the market realized that a lot of these tech stocks were significantly overvalued, it took the Nasdaq over 14 years to recover. The S&P 500 has never gone through anything even half as bad as this. The Nasdaq just holds a lot more of these speculative tech stocks that have insanely high valuations. As of the making of this video, over 51% of this entire index is made up of tech stocks. That's 51% of this index being just in one sector. So I feel a lot better with SPYI because it holds more stocks and is better diversified in safer sectors like industrials and materials. If we ever go through some kind of major tech sell-off again, like similar to what we saw in the early 2000s, I won't write off the possibility of dumping all of my shares of this ETF. Although it does have better downside protection compared to other covered call funds, it would still get wrecked in the event of a major drop. You can see here that between 2000 and 2002, the entire index fell by nearly 80%. Try convincing some 20-year-old Nvidia and MicroStrategy fan that something like this has happened in the past or can happen again. And we just haven't seen anything close to like this volatility in the S&P 500 since it first launched. But overall, QQQI has been a really good holding for me since I first started buying it, and I've been very slowly adding more shares to it as time goes on, apart from reinvesting my dividends, of course. The next company I've been buying is N REIT, ticker NNN. They're in a similar situation to Capital Southwest in that the market was shunning their stock due to some concerns investors have. But again, just a couple days ago, they released some really positive updates on their company. They're a diversified real estate investment trust that currently has 3,568 freestanding properties, which includes a lot of auto repair businesses, convenience stores, and distribution centers. The number one thing that attracted me to Triple N was their dividend safety. This is not the most exciting investment compared to the others we've looked at today, but their dividend is why I like this company. They've grown their dividend every year for 35 years straight, which I believe is the second longest track record in the REIT sector. Their dividend is currently 141% covered by their AFFO, and thanks to the sell-off, it now yields around 6%, way above average for a typical REIT. Most of this sector is still trading at a good discount, which is why one of my plans for 2025 was to load up on these investments. So like I mentioned, investors have been less interested in this company because of issues revolving around a couple of their tenants. Triple N has been working on these issues, and they did provide some good updates in their latest earnings. Their occupancy rating is sitting at 98.5%, which did decrease a tiny bit, but it's still higher than their typical long-term average. They also sold 12 properties that were underperforming, and this resulted in a pretty big profit as the value of these properties increased. In the year 2024, their AFFO grew by nearly 3%, which is slightly more than their typical dividend growth. So they're growing at a faster rate than their usual dividend increases. That's creating a better buffer, and hopefully if it continues, they'll be able to increase their distributions at a faster rate. So overall, Triple N isn't anything that's spectacular in terms of growth, but it has been very sturdy and very consistent if that's what you happen to be looking for. And then just very briefly, one more holding I've bought more of recently for the first time in nearly 5 months is the Reaves Utility Income Fund, ticker UTG. It's a closed-end fund that invests in public equity and fixed income markets in the US. It seeks to invest specifically in dividend-paying stocks and debt instruments of companies operating in the utility sector. UTG's investment objective is to provide a high level of after-tax income and total return consisting primarily of tax-advantaged dividend income and capital appreciation. This closed-end fund has done really well over the past year as the utility sector has been recovering nicely. Despite UTG not growing their distributions for 3 years, it's never gone through a dividend cut in its more than 20-year history. There was a pullback in share price in late January for this fund, which served as my main motivation for picking up more shares. Right now it makes up a little over 3.3% of my portfolio, which I'm hoping to dedicate a little more to. Utilities are one of those dividend-rich sectors that are really great for income. So that's a look at a handful of stocks and funds that I've been buying this year. Let me know your thoughts in the comments. Do you hold any of these, and are you buying any right now? Or if you think you know of a better alternative to anything I'm buying, let me know. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.